Hi everyone, my name is Jatin Agarwal. I'm a chartered accountant by qualification and now having a post-qualification experience of more than 10 years in auditing and financial reporting. In my earlier video, we gave you an overview of accounting as per Ind AS 102 or IFRS 2 share-based payment arrangements. In this video, we will be talking about how do you account for ESOPs with the help of some examples. We'll first give you a quick overview of IFRS 2 or Ind AS 102 requirements when it comes to ESOPs. Then we'll talk about some basic structure of how the ESOP schemes works. And then we'll talk about two examples. One would be an example in which the scheme would be an equity settled scheme. And second would be an example wherein the scheme would be a cash settled scheme. Before we move ahead, if you have still not referred to our earlier video on IFRS 2 Ind AS 102 on accounting considerations in a share-based payment arrangement, I would request you to please refer to that first. The link of this is given in the description box. It's a very short video of 10 minutes, but I guarantee you will get a good overview. Now, let's start with a quick overview of what we already talked about in our earlier session. We said that the share-based payment arrangement is of three types. First is an equity settled option, second is a cash settled option, and third one is a mixed category. We talked about that in case of an ESOPs, my accounting entry will not change drastically. When we avail an employee services in return for a cash, what we pass an accounting entry, simple accounting entry, employee cost account debit to salary payable. But when it comes to an equity settled share-based payment arrangement, as and when we receive our services, we pass our accounting entry, which is employee cost account debit to equity reserve. In case of a cash settled share-based payment arrangement, we pass our accounting entry, which is employee cost account debited to share-based payment liability account credited. We noted in this that my debit side remains the same, but only the credit side changes as my transaction changes. If it's a normal cash transaction, it is normally salary payable. If it's an equity settled share-based payment arrangement, it was equity reserve. It was a cash settled share-based payment arrangement, it is cash liability. As far as when this accounting entry is to be passed, the answer is very simple, applicable for both these situations as and when services are provided. Right? And how do we account for it? We'll understand this with the help of an example in this video. The only difference, or I would say one more important difference that you need to note down is that as far as this amount is concerned, that is measurement is concerned, this accounting entry would be passed with the help of fair value of the options that were granted as on the grant date. That is, I'll repeat, it is going to be the fair value as on the grant date. Okay, but in this case, fair value of the option as on each reporting date is going to be used for the purpose of measurement in this case. Right. So again, a quick summary. When it comes to equity settled, we said that in case of an employee, we are going to pass this accounting as and when the services are received, and the measurement basis is going to be the fair value of equity instrument that has been granted or the options that has been granted, and the measurement date would be the grant date. This is not going to change in my as and when my reporting period comes. Okay, this grant date fair value remains fixed in this case. When it comes to cash settled schemes, for in case of an employee, we'll again recognize this as and when services are provided, but the difference would be that we'll recognize this. My measurement would be based on fair value of the liability, and this would change at every reporting period as and when we pass our accounting entry. Right. Let's understand the basic structure of ESOP scheme. In a basic structure of ESOP scheme, generally what you will find is first is a grant date. This is the date on which an employer communicates to its employee that you are entitled to this kind of schemes and clarifies that what are the terms and conditions that needs to be satisfied for him to be eligible for these options. Normally what you will see is that these conditions that we will be talking about is categorized into three criteria: service condition, performance condition, and market conditions. We'll talk about those criteria. So at this slide, what we'll say all of these conditions as conditions only. So let's say one of the common condition is that you need to continue with the service of this organization for 3 years. Okay, let's go with a very simple example. So this 3 years period is called nothing but the vesting period. That is the period in which various conditions, be it service conditions, performance condition, or any other condition that is associated, needs to be satisfied during this period. This period is then called as vesting period. Then we have a vesting date, the date when vesting conditions for entitlement are satisfied. That means it is this is the date when employees will get to know that how many options they will actually be granted against the services that they have provided. Finally, we have an exercise date. Now, this is a broad arrangement. This is how normally an ESOP scheme would look like. We talked about vesting conditions. There are 3 categories of vesting conditions: service conditions, performance condition, and market conditions. Service conditions, it requires that employees are supposed to stay in the service of that particular particular employer over a period, right? Then that period is called as a service period, basically, and that is a service condition. As you all know, that one of the objective of this ESOP scheme is retention of employees, retention of key employees. So this service condition is something which is very common in the ESOP structures that you will look at. Then we have a performance condition. That means performance conditions are those conditions which are linked to the performance of the company or to the employees, right? Some examples of this performance conditions can be, for example, a sales target, or let's say a PBT of that particular company, or EBITDA margin of that particular company. Okay. Now, when I talk about PBT or EBITDA margin, this is basically related to the performance of that particular company. When I talk about the sales target, it can be related to the performance of that particular employee. Lastly, we have market condition. Market condition would be a condition which is linked to the equity prices of that particular company. Now, let's discuss on this example. First example, this is a very simple example that we'll start with. Let's say JS Limited has granted to its employees 5,000 share options, and each of the option is having a fair value of rupees 100, and this was granted on 1st of April 2000. And they need to remain in the organization till 31st March 2003. So basically, 3 years is something which an employee will have to serve in the organization, and then only he will be entitled to this share options. So this condition, what do we call this condition as? Service condition. Okay. So this is how this arrangement will look like. So right, so we have a grant date, which is 1st April 01, and then we have 3 years of period, and this is nothing but a service condition which is attached in this example, and finally we have a vesting date. Okay. And in this, also in this example, we are given certain facts. That's as on at the end of first year, JS Limited expects that only 91% of employees will remain in the employment. That is as on the vesting date, right? And as at the end of the year 2, it says that company expects that 89% of the employees will remain in the employment as on the vesting date. However, it says that the facts of this case says that as on at the end of the vesting period, that is on March 2003, actual number of employees who were in the organization were only 82%. Now, let's look at how do we account for this transaction at the end of year 1. First thing that we'll do is that we'll compute the total estimated expense over the particular period. You remember, we are supposed to account for this as and when services are provided. So services are going to be provided for 3 years, right? So first we'll account for what is going to be the total charge for 3 years. And that would depend upon number of options that would vest as on the vesting date. So what we are actually doing is, as on day 1, as at end of year 1, what we are doing is we are estimating that how many number of options that would actually vest as on vesting date, that is 31st of March 03 in this case. So number of options, my estimated number of options that would vest is 5,000. How many number of employees I am expected to be as on the vesting date? That is 91%. So it comes out to be 4,550. What is the fair value of this option? Fair value of this option, since it is an equity settled option, Why? Because I would be settling this liability by way of issuing my own equity shares. So this is an equity settled option. And we said that for the measurement, we discussed in our measurement principles for equity settled option that the fair value of an option will be as on the grant date. So in this question, what we said that the fair value of option as on 1st April 01 was 100. So we'll take this as a base, and the total charge which is estimated is 4550, which is number of options multiplied by fair value of each option, which gives me a total charge of 455,000. Right? What is the cumulative expense that needs to be recorded at the end of year 1? What was the total service period? 3 years. So in total service period, my estimated expense is 455,000. Only 1 year has lapsed, so my expense should be 455,000 divided by 3 number of years, total number of years, into number of years that has been lapsed, that is 1 year, which gives me 151,667. So my accounting entry at the end of year 1 will be employee cost account debit to equity reserve, which is 151,667. Now let's look at what will be our accounting at the end of year 2. At the end of year 2, again, I will make an estimation of what is going to be a total expense for this particular scheme. So I'll again have to make an estimation sitting as on 31st of March of this year, and I will make an estimation of how many number of options which actually vest as on this vesting date. So my estimation says that it is going to be the 89% of an employees will remain in the organization. That is 89% of an employees will be able to satisfy the service condition. So my estimated number of options to be issued at the end of year 2 is 4450, which is different from my earlier estimation. But in this case, my fair value of my option will remain the same. So it is 100 only. Why? Because it's an equity settled scheme and my fair value of an option will not change in this case. It will always be the value which was there applicable as on the grant date. So my total charge comes out to be 4450, total estimated number of, or I would say new estimated number of options as at the year end, multiplied by the fair value as on the grant date, giving you a total charge of 445,000. Now, this was the total charge that is applicable that you have estimated for the total scheme, which is for 3 years. And how many period have already lapsed? It is 2 years have already lapsed. So my cumulative charge at the end of year 2 is 445,000 divided by 3 into 2. This gives me a figure of 296,667. Right? So whatever is the differential between 296,667, which is the cumulative charge as at end of year 2, and whatever I have already recorded, that is a cumulative charge as at end of year 1, which was 151,667, whatever is the differential between the two is going to be my charge for year 2. My year 2 accounting entry will be employee expense account debited 145,000 to equity reserve, which is 145,000. Again, how have we arrived at this 145,000? It is 296,667 minus 151,667. Now, let's look at accounting as at end of year 3, which is also the accounting as on the vesting date. As on the vesting date, you actually get to know how many number of options are to be issued. In this example, it is 82% of an employees who have satisfied the service condition. So my actual number of options that are to be issued in this scheme is 5,000 multiplied by 82%, which is 4,100 options are to be issued. Will I change the fair value of each option? Answer to this is no, because it's an equity settled scheme. So my total charge for this scheme comes out to be 410,000. Now this 410,000 is supposed to be recorded is the cumulative charge that is supposed to be recorded at the end of year 3. I've already recorded at the end of year 2 a cumulative charge of 296,667. So whatever is the differential between the two is going to be the charge for year 3. In this case, my accounting entry for at the end of year 3 is going to be employee cost account debited 113,000 into 333 to equity reserve, which is 113,333. How have we computed this 113,333? This is nothing but the difference between a cumulative charge as at end of year 3 minus cumulative charge as at end of year 2. So finally, when this options would be actually be exercised, then this equity reserve that I have created will get debited and my share capital will get credited. In this example, we had only one condition, which was a service condition. Let's say you have another example wherein you also have a performance condition, a very simple performance condition based on, let's say, a sales target for that particular employee, right? So every year end, when you have estimated that how many number of options will be exercised, you have in this example only factored in service condition. But if you were also having a performance condition into it, you would also make an estimation based on this performance condition whether that sales target will be satisfied or not at the end of year 3. So both these conditions, performance condition and service condition, every reporting period, you'll make an estimation that what is an estimated number of options that would satisfy these conditions, these two conditions, and then do this entire competition, right? So nothing changes. If there's a performance condition also in this question, nothing changes. It's only the estimated number of options in this case, which is 5,000 into 91% on 5,000 into 89% or 5,000 into 82%. This estimation would change and rest on mechanics will remain the same. Third scenario, let's assume that we also have a market condition. In market condition, nothing changes over here. Nothing changes in this line. Only the fair value of each option, this changes. So basically market condition, you are not going to make an estimation. You are not going to consider it while making an estimation of number of options that would vest. The market condition will be factored in on day one itself when you are making an estimation of fair value as on the grant date. So to summarize, all market conditions will be factored in at the time of fair valuation only, at the time of determining the fair value as on the grant date only. As far as service condition or performance condition is concerned, these would be factored in at the time of each reporting period, while making an estimation of number of options that would vest as on the vesting date. That is in line number 1 in this row, right? And rest all mechanics remains the same. Now let's talk about cash settled schemes. Simply assume that the example that we talked about in our previous slide, instead of getting settled by way of issuing of equity shares, is getting settled by way of cash payment by the employer. How will my accounting change? Will there be a change in terms of number of options estimated to vest as on the vesting date? No, this would remains the same. When this was an equity settled example, we considered the fair value as on the grant date, that was ₹100 only. If this is a cash settled option, I will have to get the fair valuation done for these options as at each reporting period. In this case, I've assumed 120 as at year end 1, 130 as at year end 2, and 140 as at year end 3. Okay, so I will have to get the fair valuation done as at each reporting period and use that for the purpose of computing my total charge. Okay, so in this case, instead of 100 in my previous example, I'll be using 120. I'll compute my total charge and again allocate it to the period which is already lapsed and pass my accounting entry. My accounting entry in this case would be employee cost account debit. My debit side remains the same. It's only the credit side which changes. It is going to be cash settled liability. Now this is going to be forming part of my liability section of my balance sheet. Okay, now in this case, it is going to be 182,000. In year 2, again, I will use my estimation of total number of options will not change. It remains the same as it was in the equity settled scheme. My only thing changes is fair value of the option as at the reporting period. So it is assumed to be 130 in this case. I'll compute my total charge allocate it to the total, arrive at a cumulative figure of charge that needs to be recorded, considering that 2 years have lapsed, which is going to be total expense divided by 3 into 2, arrive at a cumulative figure. Whatever is the differential between the two, I will record it as an expense at the end of year 2. My accounting entry remains the same, employee cost account debited to cash settled scheme. Finally, at the end of year 3, I know how many number of options that have been lapsed, and I know what is the fair value of this option as at end of year 3. It is 140. So 140, I use it for the purpose of computing my actual charge. That is a cash liability that needs to be paid. And then this is the expense that I will record, which is based on the total expense and the differential between the cumulative expense, which was recorded at the end of year 2. Now, let's say employees have not exercised this option. Employees are now entitled to 4,100 options, but they have not exercised it yet. But there is a reporting period in between. How are you supposed to account for it? Will this 140 change again? Should this charge change? Absolutely yes, because what you record is a cash liability. So when they will be exercising this option, whenever they would be exercising this option, that is the time, at that point, that is the amount of cash that you have to pay, right? So let's say if my value of this is further increases to 150, and I'll compute my total charge or cash liability based on that. Whatever is the differential between the two, I will record this as an expense till the time my actual cash settlement is done. Okay, so in case of an equity settled scheme, the accounting for this actually stops when your vesting period has lapsed. But when it comes to cash settled scheme, you keep on fair valuing, you would say that you will keep on recording that liability till the time that actual settlement is done. And whatever is the differential between the two reporting periods, you record it as an expense in your P&L. With this, I would like to end this video, and I hope this was meaningful and helpful to you. Thank you so much.